Welcome to lecture 28 of financial management, and in this lecture we are continuing our discussion on cost of capital. So we will discuss the examples related to cost of debt, cost of equity, and cost of capital. So the first example is a comprehensive one. This would cover all the aspects of the cost of capital that we had been discussing. Now, given the following information for ABC Corporation, find the Wacc, assume the company's tax rate is 35%. So the tax rate is there. The debt information is that 8,000 bonds of 6.5% coupon bond outstanding. Its par value is 1,000. Its maturity is 20 years and is selling for 92% of the par value. Common stock is 25,000 shares outstanding, selling at $57 per share. The beta is 1.05. 15,000 preferred stock shares of 5%. The 5% is the dividend that is being paid on these preferred stock outstanding, and the current selling price of these preferred stock is $93 per share. The market information had been given, and it is 8% market risk premium and 4% risk-free rate. So we have this information. So from this information we can get an idea that cost of equity would be calculated using the CAPM model. So first we need to calculate cost of equity, and in this case it would be calculated using the CAPM model. Then we need to calculate cost of debt, cost of preferred stock. So starting with cost of equity, our formula is of CAPM is cost of equity is equal to risk-free rate plus the beta into RM minus RF. Now this part of the formula, this RM minus RF, is called market risk premium. Market risk premium. Okay, so what this means, this market risk premium means, what do we mean by this term? So if we, let's say market risk return is 8% and the risk-free return is 4%. So any investor buying a T-bill or risk-free bond or risk-free asset would get a return of 4%. Any person investing in general market would be 8%. The general market, let's say the KSE 100 index, the benchmark of the market in Pakistan is KSE 100 index. It increases by 8%, let's just say, for that specific time period. So what is the difference between this 8% and this 4% is a 4%. 8 minus 4% would give us 4%. What do we mean by this 4%? It is the extra premium, the extra return that an investor would earn if he invest in equity market, rather than investing in risk-free assets. So that's why it is called market risk premium. The difference is called market risk premium. Okay. Okay, what I did here a mistake, and this is what commonly students would also do, is that they would, instead of taking this 8%, if we go back and look at the term that had been used, is 8% is the market risk premium. So basically we had been given this term RM minus RF rather than RM. So this RM minus RF is 8%, but I also made a mistake in this example. So what I am going to do is, instead of you taking this term 8% minus 0.045, you should take 8% or 0.08 as market risk premium, because this whole amount is the market risk premium, and the 8% had already been calculated and given to us. So you adjust the calculation yourself, and let's go with the current calculations. So the cost of equity would be 8.1%. It is obviously, we have just discussed, it is wrong because it is based on this idea, but you need to adjust the calculations yourself. Okay, cost of debt. The formula is the nominal cost, the nominal interest into 1 minus the tax rate. Tax rate is 35% and nominal interest rate is 6.5%. So we get an interest rate of cost of debt of 6.2%. Now it would always be lesser than the nominal interest rate, and the reason we have discussed multiple times is because of this taxes we are getting because of this interest we are getting some discount in the taxes. So we discussed the idea that first we calculate EBIT, interest, earning before interest and tax, and then we deduct interest from this amount, and then we have earning before taxes, and we calculate taxes on this amount. So if the interest is higher, the EBT would be lower, and if EBT is lower, the taxes would be lower. So the higher the interest, the lower the taxes. So because of this interest, our tax amount is decreasing. So in essence, because of this interest, this debt financing, we are having a tax shield. Okay, so we have cost of debt. The cost of preferred stock is already given, which is 5%. We need to calculate V. And how do we calculate V? V is equal to E, the weight of equity, plus the total amount of equity, plus the total amount of debt, plus the total amount of preferred stock. Now in this example, we do not have the total amount of equity, debt or preferred stock, but we know that there are 2,50,000 shares, and each share is worth 57 rupees. So if we multiply them, then we get the total amount of equity. The total amount of equity is 14 million, around 14 million. Similarly, we are going to find the amount of debt. So we have issued 8,000 bonds. Each bond have a par value of 1,000. So it is 8 million. But currently it is being traded at, remember D is the market value. So not the book value. Book value is 8 million, but it is currently being traded at 92% of the par value. So 92% of the par value is 7.3 million. Then preferred stock, we have issued 15,000 shares and currently they are being traded at 93 rupees. So 1.3 million. V is the total capital, and that would be equal to equity plus debt plus preferred stock. We add all these amounts, so we get the total amount. But in Wacc formula, if you remember, we add the weight of E. Rather than the amount, what we need to do is we divide each amount. So for example, if a company raises 1 lakh rupees to start a project, out of this 1 lakh rupees, 20,000 would come from, say, preferred stock, 30,000 would come from, say, debt, and 50,000 would come from, say, equity. So what is the percentage of each these component? How do we find percentage? It would be 50,000 divided by the total amount, which is 1 lakh. That would be 50%. This 50% would be used as an input, as a weight in the Wacc formula. Similarly, 30,000 divided by 1 lakh would give us 30%. 20,000 divided by 1 lakh would give us 20%. So this is what we need to do. We need to calculate the percentage weight, and it would be we have the total amount. We need to divide this 14 million by total amount, and it would give us the weight of equity. So this is what we did. E divided by V would give us the weight of equity, which is 62%. D divided by V, which is 7,360,000 divided by 23 million is 32%, and this amount divided by this total amount is 6%. Now once we have the weight, we just have to input them in the Wacc formula. So the Wacc formula is E divided by V into cost of equity. But if you remember, we have already done this previously. So E divided by V is 62%. We have already done it separately. You can either do it directly in the formula, but it gets messy because of large amounts. So you can calculate the weightage separately and then enter them into the formula. Obviously, we do not need to do this because RD, we have already calculated RD. So input the values. The weight of equity was 6.2% and the cost of equity was 8.1%. So we simplify this and we get the Wacc of 7.28. So the company's cost of capital for financing is 7.28%. Okay, moving towards the next example. Suppose that this water company has a target debt to equity ratio of 50%. Its cost of debt is 9% before taxes. If the tax rate is 35%, what is the Wacc? Cost of equity had been given as 10.84%. So the cost of equity is given. There is no preferred stock. There is just equity and debt. We need to calculate the Wacc. But one thing that is different from previous example is that the debt to equity ratio had been given. If you remember from the ratio analysis chapters that we have studied in business finance or introduction to finance subject, you would remember that there were ratio analysis regarding leverage ratios, and one of the ratio was debt to equity ratio. So what is the amount or ratio of debt as compared to the equity that a firm has acquired? This is capital structure of the firm. So this 50% means that 50% is debt. For every 50 cents or every 50 paisas, there is 1 rupee of equity. For every 50 cents of the debt, there is 1 rupee of equity. So this is debt to equity ratio. But we do not need debt to equity ratio. We simply need the weight of equity and the weight of debt. So if for every 50 paisas of debt, there is 1 equity, then the total is 1.5. And the weight of equity would be 1 by 1.5, and the weight of debt would be 0.5 divided by 1.5, or we can write this as 2 by 3 and 1 by 3 in the fractional form. These would be weights, right? So this would be our formula, and if we input this in the fractional form, then the weight would be 2 by 3 into the cost of equity. The cost of equity had been given. We do not need to calculate it. It's 10.58 plus the weight of debt 1 by 3 into cost of debt. So the cost of debt is 9%, but again this 9% is before taxes. So we need to multiply this by 1 minus the tax rate, which is 0.35. I missed to enter this thing into the formula. There is no preferred stock, so there would be no cost of preferred stock. So if we simplify this, we get the Wacc of 9.17. So the company's cost of capital is 9.17. So this would become the required rate of return of the company, and if it is going to start a project whose internal rate of return is say 20%, then what should the company do? Obviously 20% is greater than the required rate of return. Then the firm should approve that specific project. Let's say it's project A, because this project is going to generate 20% return, and out of this 20%, our cost for acquiring the capital to start this project is essentially 9.17%. Our required rate of return or the cost of capital is 9.17%. So when IRR is greater than required rate of return, then the project should be accepted. If IRR is less than the required rate of return, then the project should be rejected. And the reason for rejecting the project is that, let's say, IRR is 5%. So a project, let's say project B would generate a 5% return. But to start that project, we need to acquire funds, and to acquire funds, we are going to use debt and equity, let's just say, and this is the specification that we are going to use. The cost of equity would be 10.8 and our weight would be this much, etc. So for that, our cost would be 9.17. So even if we accept the project, our return would be 5%, but our cost would be 9.17. So that's why we reject this project B when IR is less than required rate of return. Okay, last thing is flotation cost. Suppose your company, and if you remember, flotation cost is the cost that is used to float the shares or the bond into the market. Suppose your company needs 20 million to build a new assembly line. Your target debt to equity ratio is 0.75. The flotation cost for new equity is 8%, but the flotation cost for the debt is 5%. So you need to ignore this line. You need to find the flotation cost. The formula for calculating the flotation cost is weight of debt, weight of equity into cost of equity, into flotation cost of equity, plus weight of debt into the flotation cost of debt. Okay, so what is the weight? Again, debt to equity ratio is 0.75. So 0.7 cents for each $1 of equity. This would be the weight of equity would be 1 by 1.75 into 0.08 plus weight of debt in this case is 0.75 divided by 1.75 into the cost of debt, which is 0.05. So this simplify this and you would get the flotation cost.